viewing session for the audience. But anyways, excited to kick this off. Another amazing guest this week. We've got Joe Medved from Lerer Hippeau. So Joe, thanks for coming. It was good, meeting a couple months ago, and glad that we're able to connect at least real time, trying to do some storytelling. But why don't we kick this off? So I think it'd be good to learn a little more about your early career. I looked at your bio. It looks like you spent some time at SoftBank as well. So just kind of learning about the different franchises that you've spent time with. And also just learning a little more about your early career. So why don't we kick it off and talk about your early days, maybe your family, where you grew up, what you thought about studying, and then how that kind of ended with where you are with your career. Would love to hear all the different topsy turns of like how your career has taken you to where you are now.
Okay, great. Well, first of all, Joel, thanks for having me on. And I love what you're doing with Sutton, so I appreciate you including me. As we talked about beforehand, I'm a little embarrassed that my lighting is so crappy, particularly given how Lerer Hippeau's core was built by founders who created some incredible media businesses. They'd probably be very underwhelmed with my production. But anyway, so it's great to connect. So look, I grew up in New Hampshire, southern part of the state. I thought it was the big city. It was only 100,000 people. It was in Manchester, New Hampshire. So it was a small place. But my background, my folks had both been from like the nonprofit world. So my dad worked for the Red Cross for most of his life, and my mom was a math teacher. So I was never really that, I wasn't as actively exposed to, kind of the business, activities of a place like New York City. But I really fell in love when I kind of first visited here. And when I went to college, and I went to Boston College, so not too far from home, but I decided to just study something around business, and I ended up kind of in the School of Management there. I had an uncle who was an entrepreneur who'd done quite well. And so I was attracted to, to learning more about economics, marketing, finance, trying to figure out what I wanted to do. And coming out of undergrad, so I graduated, date myself a bit. So I graduated in 1999 out of BC. I came to New York City and I started a career in investment banking. And I was in banking for like 5 really long, painful years. It probably felt like 20. And it was an interesting time because I joined when the market, it was really that kind of Web 1.0 phase of the tech market. And I was working in like tech, media, telecom banking. So when I first joined, it was actually a very interesting job. They just needed kind of warm bodies at the table to collect fees. So, I was working on a wide range of like M&A and fundraising activities. And I spent actually a couple years on one transaction, which was when Comcast bought AT&T's like cable assets, became kind of it was the foundation for their large cable business. I think we made like $100 million in fees alone at JP Morgan.
Wow.
And I just found at the time I was like one of the largest M&A transactions of all time. And I just found I just wasn't as interested in it. It was like, it was a wild degree of financial engineering. And I found I was always more interested when we were working with smaller clients where we're actually providing some level of strategic guidance. And that kind of opened my eyes to the buy side world, private equity, venture capital. And I ultimately left kind of after the market imploded while I was in banking. They fired like 90% of the people that sat around me. I didn't end up going to get my MBA, which was a pretty common thing in those days because I had a gig without doing it. It felt like I was nuts to leave. But a couple of years in, I was just like, I just don't see myself loving doing this over the very long term. And so I ultimately found an opportunity to work at a fund that at the time was called Constellation Ventures, and it was part of Bear Stearns Asset Management, which was like this kind of asset management group within Bear. We were our own little fiefdom, but we were doing mostly it was kind of like Series A and B investments, but that's very different than what a Series A and B is today. Like in those days, people were still buying their own servers. Like you needed, Series A around $20 million to get something started. And I was there for a couple of years. And Bear Stearns ended up, imploding at some point. Some people that sat further close made some bad investments in the real estate space. We took no blame for it. But ultimately, I ended up transitioning over to SoftBank, which is not the SoftBank that you kind of think of in today's market. At the time, so it was an entity called SoftBank Capital. And we were like a hobby compared to the Vision Fund of today. So there ended up being a couple entities I was involved in, but we're primarily doing early stage investing, a couple $100 million fund, doing a lot of Series A and Series B rounds, mostly in sectors that were kind of strategically interesting to SoftBank's kind of core business back in Japan. But we were really operating as an independent fund. So the origination of the fund entity was actually much more strategic. My now partner, Lerer Hippeau here, had been involved in helping build out some of SoftBank's businesses in the US, but after the Webino crash, Masa repatriated most of the dollars to Japan.
Yeah.
And we were an independent entity. So I would go and I was at SoftBank for about a decade. As my career there progressed, I started going to Tokyo probably 2 or 3 times a year, and we'd meet with Masa, the CEO, and some of his direct reports. But we were more talking about just like what the trends were in the US, so they could think about how they should apply that in the Japanese market. And towards the tail end of my time there, Masa started getting interested again in investing in writing bigger checks, coming back into the US market. And what effectively happened is, Masa is prior to the Vision Fund, he hired this guy, Nikesh Arora, who had been one of the top execs at Google, who came on board, and he really wanted the investment focus to shift to become much more global, writing much larger checks. And ultimately, it was decided that this SoftBank Capital entity was something that was going to be somewhat distracting to kind of the core new strategy, which was really focused on helping drive sourcing from a lot of other early stage funds. But SoftBank didn't want to upset, co-investors and founders that they'd worked with for many years. And so what ultimately happened is we actually, and this is a fairly unique situation, we basically transitioned the general partnership of SoftBank Capital over to Lerer Hippeau.
Interesting. Okay.
I came over here with my partner, Graham Brown. And so the two of us were at SoftBank, came over here, and I continued kind of managing those assets effectively under the Lerer Hippeau umbrella. And it was an easy transition because we had actually been investors in the Lerer Hippeau fund. Lerer Hippeau used to be part of SoftBank Capital. He was there prior to my time and really helped build up SoftBank Capital. The connection basically was that Eric had invested in Kenny Lerer at the Huffington Post, Kenny and Ariana and Jonah Peretti, and ultimately became CEO and helped him sell it to AOL. And he joined Lerer and helped institutionalize the fund. And we were LPs. So anyway, so that's how I kind of transitioned over. And I've been here at Lerer Hippeau for about 8 years now.
Yeah. So taking a step back, I think there's 2 things that might be good to unpack. Just learning a little more about the Lerer Hippeau family. So was that the origins, kind of some of the liquidity or the exit that came to AOL, or was there some type of family business with the Lerer Hippeau group? And then would love to learn a little more about what you learned from Masa as well.
Sure. Yeah, sure. Yeah. So yeah, I mean, Lerer Hippeau as a fund was effectively started in 2010 here in New York. And Kenny had been involved, Kenny had been an operator most of his life. He'd done very well in kind of the PR world. He was actively involved in the early days of MTV and AOL. And he basically, brought together Ariana Huffington and Jonah Peretti to launch the Huffington Post. While he was doing that, his son, Ben, who had recently graduated from college, and Ben had grown up in New York City. He's raised here by Kenny. He went to Wharton, came back to New York. And like what he and Kenny saw is that Ben and a lot of his peers were no longer interested in taking those investment banking gigs or consulting and things like that, which were more kind of typical, exit from a place like Wharton. And Ben went out to raise money for Thrillist, which was his original business, and just didn't find a lot of capital in New York City. Venture at the time, like in the venture ecosystem in New York, it was maybe like a $2 billion market. And you had San Francisco, which was obviously a very large, somewhat insular community at the time. Boston also had a significant venture market. New York wasn't really as much on the map. But the bet that Kenny and Ben made, which has turned out to be a fantastic one, was that New York was going to rise as an ecosystem. And I just think the expectation was, look, there's a lot of interesting, emerging founders like Ben who are going to want to live in New York City, who are going to, have connectivity to some of the, major industries in our market, like media and advertising, certainly in the early days, eventually, consumer and a lot of other businesses like that, and even on the enterprise software side now, obviously. And they were going to make a bet that New York was going to kind of grow in that regard. And particularly for emerging managers on the call, listening to the conversation, like that first Lerer fund was $8 million. It was small, right? And it was really mostly their money and some of their friends. And I think that first fund, over the first few sets of funds, like the team really backed some of the kind of iconic names in New York City. I mean, the Huffington Post was a great success. Ben turned Thrillist into Group 9, which he sold last year. They backed BuzzFeed and MakerBot and Moat, Warby Parker, Venmo, like a lot of names really helped put the New York City ecosystem on the map. And basically then in Fund 2, after the Huffington Post was sold, Eric had been CEO. He joined Kenny and Ben, and they realized that like they could really institutionalize and try to build like a dominant early stage platform here in New York City. And so that's, that was the origin.
Yeah, no, that's really helpful. And then, I asked about Masa because, I've seen both of the WeWork document. I saw the theatrical one that was on Apple, and then I saw the actual documentary that was on Hulu. And I mean, both of them kind of talked about, how it was to collaborate with Masa and just his mindset. So, my thoughts on Masa is like, look, he takes really, really big bets if it's the right founder, obviously. And then, he's raised significant capital from the Middle East. But I have to know that like, there's definitely been some amazing learnings just working with him that intimately.
Yeah, and to be clear, like really when I was actively investing in SoftBank, like Masa was relatively disengaged. So I would certainly, I'd be in the room with him and work with him on some opportunities, but like, and I'm still close to a lot of the folks that have remained at SoftBank and work with him very actively. But, in the time that we spent with him, I mean, he really is, he's one of the most interesting, charismatic individuals you'll ever meet. He has a 300-year vision for SoftBank, right? I mean, how many of us are thinking, well beyond our lifetime in terms of the impact we can have? And I think his ability to have that kind of long-term patient view has enabled him to obviously generate an insane amount of wealth, going through cycles where a bunch of people think what he's doing is insane. And obviously in a downturn like this, he may be down, but I'd never count him out. I mean, I think he lost the single largest amount of wealth in like the history of the stock market in a matter of a few days, like around the Web 1.0 crash, right? And like, you'd think someone like him would have been hung out to dry, but he came back and made some phenomenal investments. Like actually my partner Lerer Hippeau had helped bring him into Yahoo, which was an incredible win. And obviously his bet on Alibaba was just astounding. So, there clearly are challenges at SoftBank now, as there are with kind of every major fund, but yeah, he's just someone who he just has this ability to kind of see, in the very long term in the way that most cannot, and to, use that singular vision to drive a lot of success. And so he's clearly challenged now, but like I said, I would not by any means count SoftBank out over the long term.
Yeah. There was a really short clip from Chamath that kind of broke out how Masa manages his downside as well. So he kind of hedged his assets in Alibaba and made sure there was some type of, short stops to kind of just make sure that they don't lose money, with just kind of the public markets and how they were managing their investments. So it was really interesting how, at that scale, you really have to think about other assets that can manage your downside, especially when you're taking such big bets, So I thought that was really interesting.
Yeah.
I would say like with this thesis on media, some of you guys have invested in really interesting media companies. How do you see that evolving now with short form? So I actually got to meet some pretty well-known creators recently, and there's different use cases for different types of content as you consume it, right? So if you're sitting on the toilet, you're not going to be watching an hour podcast. You're probably going to be doing that maybe while you're at the gym. But you're going to be consuming little bites as you're walking somewhere or waiting in line. So, with kind of the evolution of short form content and just kind of with the media platforms, I guess, what are some things that you're seeing in terms of the early stage investing?
Yeah, I think, look, the places where we've had significant success in media have certainly been around more short form, bite size, more easily consumable content, right?
Yeah.
I mean, even in particularly like in what Ben built at Thrillist, and you look at some of his properties like Now This in the Dodo. I mean, he generated billions upon billions of monthly views across all of these platforms, right? And so I think, and that was, but look, I mean, would we invest in another company like that in today's market? At the early stage, it's tough because there's so much saturation of content there. TikTok obviously is so dominant. Instagram Reels is really taking off. But, you know, every once in a while, these interesting new models do emerge. We were early investors and lucky enough to be involved in Axios, which really did a phenomenal job, not even with video so much as just really their kind of smart brevity format. And they figured out a way to deliver really succinct, high quality news with very strong voices in a variety of verticals, you know, whether it's politics or business news, tech, et cetera. And that led as well to a very, you know, significant exit for the fund. And so I think, but like, it's harder with some of the like a lot of the newer apps now. Obviously, a lot of the content is being driven by a wide variety of creators, and there's a lot of value to be made there. But a lot of it is going, as it honestly probably should, to the creators themselves. So I think it's a little harder to make a bet as an early stage investor on some kind of new emerging platform because it always feels like it's somewhat saturated there. But you never know. Like a Threads comes out, and although of course that is owned by Facebook or Meta, sorry. But I do think creators are going to continue. Like we've invested in a range of kind of creator tools. And we believe that individual creators are going to continue to generate really significant value in the space. But there's not necessarily a venture bet, I think, you know, that was as, shall I say, kind of as easy as it may have been to make some of these calls, you know, 5 to 10 years ago.
Sure. And tell me a little more about your thesis. So you know, I know you guys do some media and, you know, content creator companies, but are you guys more of a generalist, or do you guys have certain sectors that you guys like to play in more than others?
Yeah, we are absolutely a generalist fund, but we tend to go fairly deep in certain sectors. And I would say, and the benefit of the strategy is it's evolved over the years, right? So when the bet was made at a very early stage, particularly in New York, where we do about 2/3 of our investing, you know, the early days of the fund, it was probably 80 to 90% consumer investments, right? And this is when it was relatively novel to sell direct to consumers online, right? When companies like Warby Parker and Allbirds and Casper and Glossier were, you know, acquiring customers online. And then we really do just want to back great founders, and they have pulled us into a variety of other sectors. So, you know, we went fairly deep around digital health when we saw a lot of interesting founders kind of going into that space. We backed Alon Block at K Health, who had previously taken Wix public, when he saw an opportunity to leverage, you know, an interesting data set to try to disrupt primary care, leveraging neural networks, right? And we've now done a bunch in that segment. We more recently have been quite active around, you know, kind of clean tech initiatives generally, like a lot of focus around home energy transition. We backed a founder in the Carolinas in a company called Palmetto, which has built a very large business, actually, which Chamath is also involved in, that is focused on driving kind of solar adoption for residences. And now we're investing in battery installation and heat pump installation, kind of a lot of those segments. So we'll tend to kind of find these emerging sectors, which honestly a lot of the great founders we've backed go into, and then try to go fairly deep in those segments, often honestly like co-investing with the folks that we back early who kind of carve out space within that specific vertical.
Yeah, and I mean, just kind of thinking back to a few things you said earlier, just the 300-year plan. You know, I think as human beings, you know, as we get to like 40 years old or 50 years old, we start thinking more about being present for our families, having prioritization of time, and we might be thinking like 30 years out, right? It's like, hey, this is my lifetime. And then as a family office, you're probably going to be thinking, hey, you know, what's G2, what's G3 going to do? So, you know, just kind of switching gears, you know, what are some things that you're hearing from the LP perspective? You know, they're thinking about probably liquidity. They're also probably deploying less. They're probably deploying more carefully. But love to hear, you know, just maybe some of the water cooler talk on just LPs, maybe from some of their emerging managers, and kind of what, maybe some feedback you're hearing from the market.
Sure. Yeah, no, it's a timely conversation. I mean, we've been catching up, not surprisingly, with a lot of our LPs in this environment, getting a sense for, how they're thinking about the market. And we also, and particularly in New York, where we are really actively investing with a number of emerging managers, we're also trying to help kind of cultivate our community of great emerging managers and helping with connectivity to a number of our existing LPs. And I'd say, I mean, they're not surprisingly, a lot of LPs are obviously kind of stepping back a bit just because, the private markets don't get written down as rapidly as the publics. But I would say like a couple of factors that have been interesting to us. So one is like the folks that have been in venture forever, that have been through a lot of cycles, in a way are somewhat salivating, right? Like for new capital going to the market. So as long as they have liquidity or the ability to commit to new funds, they know that like if you look over, throughout history, like these vintages are typically the best performing. When most people are running, markets are coming down. And when you combine that with this platform shift around LLMs and everything that's kind of driving the community, and obviously there's a bunch of froth with that, but like the combination of those two things should make, this, 2023, 2024, 2025, like some really interesting vintages if you get in the right funds. So I think there are some folks that are actually, really interested in putting money to work in the space.
Yeah.
They have their liquidity constraints. For sure. But I think the other piece is a lot of the family offices, like if I look at family offices 10 years ago versus today in venture, there's an incredible leap in the level of sophistication that family offices have around venture. Like far greater interest in co-investments, getting more actively involved in just learning from, what's happening within kind of the venture ecosystem. You always have to be cautious as a family office that like people aren't just pulling you into their crappy deals. Honestly, like you really have to have trusted relationships with the folks that you're working with to make sure that like, we're bringing you in because, the top 25 funds all passed and no one else wants it, right? You have to be cautious. But generally speaking, like we actually are seeing quite a few family offices interested in putting money to work. But I think and just like we are with our fund, like the pace is just slowing, right? People are taking longer to make decisions because they're not being forced to make that quick call. But our sense is that there's still a lot of capital that people want to put to work, within the venture landscape. But it's just going to be a lot slower. And it is definitely for emerging it's interesting. Like there are a lot of LPs that have asked us for introductions to like really high quality emerging managers, but they are very like the bar is so high for a lot of these places now to put money to work, especially if it's become a more kind of institutionally structured family office where there's an investment committee that's looking at where like even like buyouts are priced now and obviously cheap prices in the public market. It can be hard to get some an emerging manager deal across the line.
Sure. Yeah. I mean, I've also seen family offices. I mean, as far as their evolution, I've seen them in the last year just raise a lot of outside capital as well. And they've raised multiple funds. So some families have raised one fund that's a fund to fund vehicle, and then another fund that's doing late stage, another fund that's doing early stage. So they're definitely not tapping into their own holding company or their own balance sheet. They're definitely mitigating their risk by, raising outside capital. So some of the families are also emerging managers. I've personally just seen some of the best deal flow from just, the cohorts that we've been running, because all these funds, they have to showcase their best deals to get noticed, as they're kind of building those relationships with LPs. So that deal flow I've seen has been a great way to build that first relationship. And then I've also seen different LPs kind of look at it as like a multi-asset approach too. So not only are they doing privates, they're also doing some public strategies as well. I think it also depends on the background of the LP too, to figure out what they're leaning into the most.
Yeah. So. Yeah. Totally. Agreed. I totally agree. And you guys are, I mean, I love the program that you're building too, but I'm curious for your take on emerging managers in this market, right? Like, do you feel like, are you still seeing kind of adds as much interest in folks trying to kind of branch out on their own and raise that first fund?
So, there's so many parallels to, fund managers being startups, right? So the best ones that are able to close capital, build that momentum, they stay. And I've seen fund managers actually shut things down, and, they've done that, or they've even taken a huge haircut to kind of have a more manageable AUM that is realistic. So I've seen both of those things prominently, but I think that people there were, I actually, the event that you couldn't make, I did like a 10-minute overview on insights that I've seen in private equity and VC. One big insight, I think this was quoted by ENIAC. So I think it was Hadley Harris. He posted this on LinkedIn. So I screenshotted it. And, ENIAC was saying that he spoke to a bunch of LPs, and what they've been saying is like the fund managers that have done really, really well on Twitter, they're actually they're having a huge problem now, raise their second fund because of performance issues. So I didn't even know that, but that was an interesting insight. So I think, the same pattern that you're seeing with founders trying to get to their next round and still build momentum and still survive. I see so many parallels with emerging managers, because what is an early fund? It's a startup, right? You're kind of building a proof of concept fund, trying to get traction. But there are people that have certain niches that do resonate really well with LPs. And, I think if you can build an engaged community around that niche. So climate change, I've also seen patterns. I feel like I'm on the podcast now, but I've also seen patterns with different theses within the application going into my cohort. So my last cohort, I saw a lot of healthcare funds, but before that, I saw a lot of climate change funds. So it's interesting for me to kind of see the patterns of people that are even interested in joining my program, and then just kind of seeing which ones end up being in the program. So I think healthcare is an interesting space, both in the private equity and venture side. I've seen a lot more LPs just generally interested in that. Maybe that's just kind of a pattern of, market conditions. People lead to healthcare more efficiently. And then, you've talked about some of the energy deals that you've done. I've directly done some energy and climate change deals, but some of those funds have done really well, especially the infrastructure plays. So some of those like more boring businesses and like the healthcare businesses, I've seen LPs kind of lean into that more, maybe as a result or a side effect of, the top level market conditions. So, but it's been, what I've seen also is just kind of content education around that sector and bringing people together as given traction. And then, depending on how you're classified on Twitter, that could, help you, build more traction as well. But yeah, I mean, I it's across the board. I think it's just your ability to raise capital, just like founders. That's kind of my opinion. So
no, I agree. Look, and I love co-investing with funds that are experts in boring sectors, because we tend you do well in those segments. I mean, like we're looking into like in the environment, we're looking into forestry stuff, right? Or like I spent some time, it was a year or so ago, looking into waste management, which is like $1 trillion industry. Right.
Wow.
That's less sexy than trash and recycling. But that is like, as an emerging manager, if you can carve out a niche where you're kind of a clear expert in maybe an underserved but valuable segment, and you're consistent with that, it feels like there's an opportunity there. It's harder if you're like, oh, I'm a crypto fund today, and tomorrow I'm an AI fund. And if you lack consistency there, it certainly creates a lot of challenges with LPs.
Yeah, and it's been eye-opening too, seeing some of these other investors that kind of have a different investment strategy. So I don't know if you ever follow Cody Sanchez, but she's kind of like this micro private equity investor. And her whole thesis, she shoots a lot of content on TikTok and Instagram talking about boring businesses. So she'll buy, these laundromats and buy these healthcare facilities that are generating like recurring revenue every month. And then she'll buy them out. She'll get seller financing. So I think there's opportunity, especially in these kind of market conditions, to also maybe get exposure to some funds or some investment vehicles that do have some recurring cash flow. And then maybe there's a private equity style approach where you can kind of sell them for a certain multiple. And there's parallels to that in late stage and secondaries, right? Because the multiples are lower. and there's a little less risk because there's more traction. There's either profitability or predictable revenue. So I've seen some of that. I mean, just even as an interest for me, just seeing some of those kind of assets, be kind of interesting. And her whole thesis is just boring businesses. So hey, I buy these infrastructure companies, I buy garbage disposal companies, trucking businesses that just it's kind of the businesses that you always need. And we're both friends with Sarah Anderson, right? So Sarah Sarah was on my show 2 weeks ago, and her thesis, which she mentioned on the podcast, is she focuses specifically on essential services. So you're always going to need healthcare, you're always going to need good food to eat, you're probably always going to need garbage disposal. So I think there's a really interesting niche and thesis around just businesses that you always have to do your taxes, right? So those are kind of things that have been just interesting insights that I've just noticed in the last couple months. So
people get sick no matter what the cycle is. People get sick, and they need to take their trash out. So there's always an opportunity.
And so maybe some advice for emerging managers. You guys have built a pretty good platform in institutional practice. So, if you're training maybe new managers that are coming into your practice, or just kind of giving some tips to, managers that are kind of on their fund one, what would you advise them to kind of just refine their practice? Maybe a couple things to guide this discussion is how do they source and screen deals? What's the best way to kind of evaluate deals, evaluate founders? You got a lot of battle scars from the decade plus of time investing. And some of these patterns don't change, right? I mean, it's been the same kind of thing that you look at when you're evaluating a founder, and then just kind of sourcing and screening. So any tips you have for just emerging managers, just refining the skill sets?
Yeah, I think so. I'll touch on sourcing first and then kind of talk through screening them. So I think on the sourcing side, as an emerging manager to really win, I do think you often it's tough depending on the market you're in. If you're if you were entering New York like Lerer Hippeau was, a dozen years ago, you could be a generalist by nature. It's obviously, I think, harder to break into the market today with that strategy. It's not like it can't be, but generally speaking, as I think about our strategy, we're going to generally buy 10+% ownership of any round. We're writing a few $1 million check, and we always want to bring in co-investors. And we're very focused on finding emerging managers and angels, sometimes strategics, that we feel are going to really add a lot of value. So to the extent you have developed an expertise in whether it's waste management, or it could be AI or healthcare, whatever it may be. Really get to know the funds that are investing in the companies that you admire and have interest in, and try to kind of network your way into those folks, and stay top of mind, which you can do by obviously certainly reaching out to connect with frequency, but also by sending some quality opportunities that you see, so that when they're when some larger institutional fund sitting around the table said, okay, we've committed to this round, we need to bring in another $500,000. Who are the co-investors we should share this with? So I think if you have that certain level of expertise, that's certainly beneficial. And then I think in terms of really then screening the opportunities too, I think the thing that I've learned over the years, and I certainly made plenty of mistakes, in my career as an investor, especially and I think this particularly applies at early stages, you want to bet on people, not ideas. I mean, particularly when you first started investing, you might fall in love with a concept. Maybe there's even some early data that looks really promising, but that clouds your judgment around the quality of the team. And without fail, across so many industries as you've seen, ideas are relatively cheap. Execution is certainly unique. So you really want to make sure you're backing the right horse, or kind of stable of horses. And to do that, it really requires spending significant time with that team, heavily referencing them. It still shocks me sometimes how we may be involved with some kind of company, or maybe we have some close connectivity to someone, and they go, and maybe there were challenges with prior business that they were involved in, and we had some relationship, and they're able to raise this new round, and it kind of surprises you in a way that that people are not diligencing those individuals, right? Like, or we'll see even sometimes like executives at companies that we're involved in get recruited away, and you're like, well, why? It's shocking when people don't reach out to do, off-book references. And it doesn't mean you go behind the back of founders, but I think you should be clear and upfront with them. Like, look, I really want, I want you to obviously provide me with some references, but if someone asks you for references, obviously you're not going to send them your mom or dad, but like, you're going to send them people that you're friendly with, that are going to say good things. We very much like to let people know, look, we're going to reach out to folks kind of in around our orbit. What we also try to do, and to the extent you have an existing portfolio, particularly in a specific segment, is, assuming you've kind of earned the right to do this by providing a lot of value to your portfolio, really leverage the founders you've backed to help you diligence these opportunities, or leverage the LPs you work with. Maybe you have a family office that is an expert in real estate and you're looking at something in prop tech. Like, obviously leveraging those individuals to, like, people who are true experts is wildly valuable. It's you have to factor in multiple data points, but and particularly as you scale, like we very actively leverage the network of founders, and we've worked with 400 plus companies at this point. Inevitably, there's a lot of great connectivity there to help us with diligence, because if you're doing something that you're not a complete expert in, you can be sold on it just like anybody else. And so bringing in experts around it to really help reference these things is also wildly helpful.
What about, let's talk a little more about portfolio construction. So if you're an early manager, most of the managers do have a concentrated strategy, right? They're trying to deploy and prove their concept of their minimum viable fund. Yeah. And they're also leaving a significant amount available for follow-on. So I don't know if you resonate with that as well, and just kind of prove out that strategy. It's a repeatable strategy, and then just do the same thing again at maybe a 2x scale for fund 2.
Sure. I think, and there's obviously a lot of different schools of thought on this. I think you lived through, so let's go back 18 months prior to now, and 8 years prior to that, you probably could be okay with pretty limited reserves as a strategy, but that's because the market just kept going up. In a market like today, when it's going down and everyone's passing the hat for additional capital, this is when you feel the pain if you have no reserves, or if you haven't built up relationships with one, the founders you've backed, and two, the co-investors that are around the table to try to help, negotiate something where you're not just going to, lose all your value. I mean, like, nothing hurts more than in a market like this when you actually made the right bet on a team and a strategy, but you don't reap the rewards effectively because of financial engineering, right? Yeah. Where, the company raised too much money, or maybe there was like a newer late stage investor that's trying to pay for, their last sins, and like, you have no capital or, available, or any other form of leverage to avoid getting crammed down. So I definitely think, it's definitely helpful to have some level of reserves. Obviously, that can be challenging if you have only so much capital to put to work. Sure. But generally speaking, I think there should be some level of it. I mean, the traditional structure, and what we typically do is it's really kind of, 50% is going into new investments, and we have 50% for reserves. Now, obviously, those reserves they're not going into every single company. Not all the companies are going to make it to the next stage. But I think what LPs want to see is that you have a disciplined reserve strategy where you're continuing to kind of back and support your winners over time. But some people take it to extremes, like some funds which have done exceedingly well, like we'll back up the truck on their best companies. And sometimes that can work. Like if you truly are an expert in a segment and you're going to make 12 to 15 bets, and you start out at kind of seed and you're making a range of them, if you really know the segment well and you effectively are conducting diligence on a company for 5 to 7 years as an investor, you might have a better eye than anyone else in terms of where you should really back up the truck on the winners. You just have to make sure that you can withdraw your emotion from those decisions. Yeah. That's where having partners certainly helps to kind of keep you accountable, so that your judgment doesn't get clouded. That there can be issues in partnerships sometimes when people are heavily focused on individual deal attribution because you want to kind of save the 4 companies you've backed. So there's got to be a balance there, but generally speaking, we think it is certainly helpful to have some level of reserves.
Yeah, and you mentioned, leaning in with the LPs. So I think that's a great way to build some goodwill with LPs too. Just have them be involved in the process. I mean, some people don't want to be involved; they just want to
Sure.
get the quarterly update. But I think if you get, some goodwill and some relationship building with the LPs that want to be involved or just kind of involve them in the investment committee, I think that's a good strategy too. And there's a fund that I thought was really interesting that was like, look, I know you're not probably going to allocate, this quarter, but hey, here's an interesting deal. I would love your advice on this. So, it's still very resonant where if you ask for advice, you might get capital. If you ask for capital, you might get advice. And it's the same thing for jobs, right? If you ask for a job, you might just get some advice. And, so I think there's so many parallels to that. But I think just kind of leaning in and maybe, asking for feedback could be a good way to just get that initial touch point before your quarterly report.
100%. I think that's super valuable. Like you want, especially if there's bad news, it's often better to
Mm-hmm.
keep people up to date on it.
Yeah.
And one other thing to think about too in this market that I know a lot of the larger LPs are interested in too is like in a lot of the conversations I've had, the one place where a lot of them are interested in putting money to work is in secondaries. And so to the extent, if you are an emerging manager and you've got a fund where maybe you have an LP or two that has become a little more desperate for liquidity in this environment, one potential way to open up a relationship with new LPs is to provide access to, a secondary stake in your fund. And that gives them, the opportunity to kind of diligence your fund, get to know you, write a small check. Obviously they're getting in at in this market, sometimes at very healthy, discounts. But that's another way to kind of build that relationship and hopefully get those folks to then come in and participate in later funds.
Yeah, and then also, I mean, you've probably seen this too, but just selling your pro rata rights. If you got some extra shares in the pro rata, kind of selling that over to your LPs if they want to get some additional upside. Because you're probably coming in even if you come in now, you're probably coming in at a decent price point. So I think that's pretty interesting. What have you seen and what have you heard from the water cooler from the emerging managers that are trying to get to their first close or trying to at least just get to their second or third close? How and what I've seen too, I mean, we were supposed to meet up, I think, at my allocator summit. I purposely did that in November because I knew right after Thanksgiving, everything's going to slow down. So I would say this, in my opinion, is like the last sprint until, the holidays. So, what are you kind of hearing as far as just closing the loop on, some deals and just kind of getting to that maybe second or maybe even final close?
It's definitely, it's hard. It's hard. I mean, look, and honestly, there are, I think to the point, Hadley probably made on Twitter, and I saw that same thread too. It's like, there's some really high quality funds that similarly are having trouble. I mean, there's been very publicly, some of these massive late stage funds are dramatically reducing their fund sizes. So it's not just you if you're going through it, but clearly it is a lot harder. Like there's always a flight to quality or known entities in markets like this. So it really, like, one, obviously you have to have as much patience as possible. But two, I think like if you're in a situation where you can't quite hit the bar that you were hoping to get to, like I said, Lerer's first fund was $8 million. It was a different market, to be fair, but I'd also argue it's easier to start companies now. Like, I mean, a company that in that fund in 2010, the $1 million that might have been written into a company then actually goes quite a bit further today, just with advances in technology.
Well, also, I don't have the multiplier, but like, I mean, 8 million back then was what now? Probably 25, 30 million, probably maybe two times as much, I'm assuming, right?
Yeah, absolutely. I mean, it's just like it's a different environment. So like you can put points on the board in this market with somewhat smaller checks. And even some of the early Lerer checks, like $50,000, $100,000, they were small. But so if you can't necessarily get, like, say you wanted to raise 20 or 30, 45, and you can't quite get there, so long as the LPs are willing to let you kind of get started, putting money to work, if you have to raise something slightly smaller, maybe try to adjust the strategy slightly just to put points on the board. So you can, and part of it too is also just like demonstrating you're getting access to high quality deals. And maybe it's either, demonstrating it's really high quality serial founders, or maybe it's with other high quality funds, showing that you can get those kinds of checks, ascribed to your fund will potentially help you raise, get to that final close, or even if it's not now, raise the somewhat smaller fund now so you can start to get things going. Make sure you have enough time for the market to hopefully turn a bit, but for you to be able to, basically add some of those great logos to your fund. I wouldn't do it. I wouldn't go writing the $50,000 check into the $40 million foundational model investment, but things that are, probably like earlier stage novel, but high quality teams that an LP is not going to clearly not going to get access to on their own, that you can demonstrate you can provide exposure to.
So no, I totally agree with that, and I think the funds that I've seen who have done well and completed their close, they're raising and deploying at the same exact time. So they've only raised maybe a sixth or seventh of their fund, but they've already done maybe 5 or 6 deals. And what they do is they give updates whenever that deal has been done, and they'll also leave a small allocation where if you don't want to be an LP, you can at least just kind of be involved, give some feedback, and also just maybe do a small SPV into that deal. So that's also been a great way to kind of just get that first check in. You build that trust, and people like the taste of that smaller deal, even especially with a smaller minimum if it's an SPV, and then that kind of feeds into maybe the relationship building for maybe the next fund, or just getting those final checks into your first close.
Yeah, 100%. The SPVs too, because then if it feels like you've got kind of a bigger bat because you can bring in some of this extra capital, that might help you get access to better deals as well. And like you said, it's just like it gets them, like it's a lot easier for LPs to invest in known assets, right? That they can do, as opposed to a blind pool, for sure.
Yeah. Well, this was amazing. I know we got 10 minutes left. Maybe we could talk about, I've had a lot of emerging managers also seek talent as well. So they're looking for scouts, they're looking for analysts. You guys, I think, have an open role. I think I shared that the other day. So what do you look for when you're hiring maybe an analyst to an associate to a principal? What are maybe the skill sets that you would recommend maybe emerging managers to look for as they bring on, junior people and then maybe develop their talent to grow in their leadership?
Yeah, I think, look, so if you have a similar strategy to ours where you're coming into early stage businesses, generally we just want to find people that have a really high motor, that are, very self-motivated, right? I mean, every venture fund is a small company, right? Like you don't have the ability to, like, it is an apprenticeship model to a certain extent, but like you need people that know how to get out there, that are wildly curious, that are naturally going to be seeking out emerging founders, like that want to go to that hackathon on the weekend, right? That want to go to that second event on Thursday night. And it can't be just that. It can't be someone who just wants to go out and socialize. And to Hadley's point, also like just, build up a big Twitter profile. But like it's someone that does that, plus is going to kind of earn the respect of high quality founders and help get them in the door. Because really, like at early stage, like our kind of analyst associates are incredibly actively involved in helping source opportunities. And we have very intentionally built a multi-generational firm. Like if you look at, Kenny and Eric are really that first generation, and there's folks like Ben Lerer and Grant Brown, who I mentioned, and Andrea and Isabel and Caitlin, all my partners that are really that kind of second generation. But then our kind of associates and analysts are that next level, who, for certain opportunities and sectors are just closer to founders. And so I think you naturally want to find those people. But like I said, you want to find that natural curiosity in someone who's really gregarious, that is going to want to be out and is going to be a magnet for kind of talent, people that want to be in and around them and reflect your brand well.
Sure. Well, hey, Joe, this was amazing. I know you spent a lot of time with me, so thanks for being generous with your time, and hope to hang out again soon in the future. We're both in New York, so we'll catch up soon.
Definitely. I'll have better lighting next time too, I promise.
You look fine, man. You'll do great, and appreciate all the time, and catch up soon.
Awesome. Thanks, Joel.
All right. Bye.